We all work hard for our money. But what about making that money really work for us?
Exactly.
That's where investing comes in. And today, we're taking a deep dive into mutual funds. They're a popular option for new and seasoned investors alike.
Yeah, it's a great topic. Mutual funds can seem a bit mysterious, but once you get the basics, they can be such a powerful tool for building wealth.
So for someone who's brand new to investing, how would you explain what a mutual fund is?
Okay, so imagine a bunch of people, they pool their money together
Okay.
to invest in lots of different things like stocks, bonds, you name it. And that's basically what a mutual fund does. It takes money from lots of investors and then uses all that money to make this diversified portfolio.
So it's like teamwork for investing.
Yeah.
We all chip in, and then someone who's more of an expert kind of takes care of it.
Exactly. That's where the fund manager comes in. They're the financial expert.
Great.
Right. So they're researching and analyzing and making all the investment decisions for the fund. So it's like having a personal investment advisor, but without that big price tag.
That sounds pretty good.
Yeah,
Especially for someone like me who doesn't spend all day, every day tracking the market.
sure.
But I'm guessing there are different types of mutual funds, right?
Oh, yeah, absolutely. There's different, I guess you could say flavors of mutual funds suit different investment goals, risk appetites, things like that. We can start with maybe the three main categories: equity funds, debt funds, and hybrid funds.
Okay, let's unpack those a little. What makes them each unique?
Okay, so equity funds are the ones that usually get a lot of attention
Okay.
because they're mostly invested in stocks. So think companies like Apple, Tesla, or Amazon.
Right.
Those are the kind of assets you'd find in an equity fund.
So for investors who are looking for those potentially higher returns, but also comfortable with maybe a bit more risk.
Exactly, yeah. Equity funds tend to be more volatile, so that means they go up and down in value, more dramatically than other types of funds.
Okay.
But over the long term, they have historically offered the potential for bigger growth. Now, on the other hand, you've got debt funds, which are considered less risky.
So if equity funds are like the thrill ride of investing, debt funds are the scenic route.
That's a great analogy. Debt funds invest primarily in these fixed income securities, like bonds.
Okay.
So those are basically loans that you're making to governments or companies.
Right.
And they pay you back a fixed interest rate over a set period.
So you're not necessarily going for those huge gains,
Yeah.
but you're looking for that steady and predictable income.
Exactly. And they tend to be less affected by those market fluctuations than equity funds. So they're good for people maybe who are closer to retirement or just have a lower risk tolerance. For example, a debt fund might invest in government bonds, which are considered very low risk. Those bonds will pay a fixed interest rate, and that provides that steady income we talked about.
Got it.
Okay.
Yeah. Now, what about those hybrid funds you mentioned before? Where do they fit into all this?
Yeah. So hybrid funds, just like the name suggests, are a blend of both equities and debt instruments.
Okay.
So they're designed to strike a nice balance, right, between risk and return. So they might appeal to investors who want some of both but aren't ready to go all in on one or the other.
Yeah, so a little bit of the best of both worlds.
Exactly. Yep. So you get some growth from the stocks and stability from those bonds.
Okay, great. Now, there's one more type of mutual fund investment we should mention.
Yeah.
And it's especially popular with new investors. Systematic investment plans.
Or SIPs.
SIPs? Could you break it down for listeners who might not know what that is?
Sure. So with a traditional mutual fund, you might invest a lump sum of money all at once.
Okay.
But with a SIP, you invest a fixed amount at regular intervals. Could be monthly or quarterly.
So it's like setting up an automatic savings plan,
Yes.
but instead of letting it just sit in your bank account, you're actively investing it.
You got it. You're exactly right. And this approach is particularly powerful because of this thing called compounding, right?
Right.
Over time, all of those small, consistent contributions, they really add up
Yeah.
because your earnings get reinvested and they generate more earnings.
I'm starting to see why people get excited about mutual funds.
Yeah.
So we've talked about what they are, different types. Let's talk about why someone might choose this over, let's say, just picking individual stocks. What are some of the biggest benefits?
Well, one of the biggest advantages is this thing called diversification.
Okay.
So you remember how we talked about mutual funds investing in lots of different assets?
Right.
Well, that diversification helps you spread out your risk.
So that's like, don't put all your eggs in one basket.
Exactly.
If one investment doesn't work out, you're not completely sunk because you have others that might be doing well.
Exactly. Imagine two investors, right?
Okay.
One puts all their money into a single tech stock. The other invests in a diversified mutual fund. So that includes tech, healthcare, and energy stocks.
Okay.
Now, if the tech industry suddenly takes a hit,
Right.
that first investor could lose big time.
Yeah.
The second is probably going to be cushioned by how those other holdings perform.
Right. So that really illustrates the diversification. What other benefits are there?
Professional management. Remember those fund managers we talked about?
Yes.
They're bringing years of experience and expertise. They're analyzing market trends, researching companies, making informed decisions on everyone's behalf.
So it's like having a team of financial experts working for you.
You got it.
It takes a lot of the pressure off, especially for someone new to investing or someone who just doesn't have the time to do all that research themselves.
Exactly. Like we said, like having a personal advisor, but, less expensive. Now, let's not forget about liquidity. That's the ability to easily buy or sell your investments.
Okay. Because I imagine with certain investments, it's a real hassle to get your money out.
Right.
Is that a concern with mutual funds?
Nope, not at all. With mutual funds, you can buy or sell units whenever you want. So that's a big advantage over some other investments that might lock up your money for a set time period.
If you need to access your money, unexpected expense, you're not stuck.
Exactly. And of course, we've got the convenience and discipline that SIPs offer, right? Setting up those regular automatic investments can really help you build good habits and make investing a part of your routine.
Okay, so it sounds like mutual funds offer a ton of advantages,
Yeah.
but I think it's important to be realistic here. No investment is completely without risk.
You're
So what are some of the downsides that listeners should keep in mind?
absolutely right. While they offer a lot of benefits, it's important to understand the risks too. One of those is market risk. That's the chance that your investments could drop in value because of things like economic downturns or interest rate changes.
So even with diversification, it's still possible to lose money in a mutual fund if the whole market takes a hit.
That's right. But remember, market risk is just part of any investment, really, and diversification helps a lot to reduce that risk. It's always important to invest for the long term and just ride out those market ups and downs.
Okay, that makes sense. Any other risks we should talk about?
Yeah, something else to be aware of is the expense ratio.
Okay.
That basically means the fees that come with managing a mutual fund. So these fees are taken out of the fund's assets, and that can reduce your returns just a bit. Think of it like a yearly fee for having a pro manage your money.
Okay. So how can our listeners make sure they're choosing funds with reasonable fees?
Well, you always want to compare those expense ratios across different funds before you invest. Generally, funds with lower expense ratios are better because they let more of your investment, actually work toward growth. For example, let's say there's an expense ratio difference of just 0.5%.
Yeah.
That can really affect your returns in the long run. Imagine you invest $10,000. A fund with a 1% expense ratio will cost you $100 a year, but a fund with 0.5% will only cost you $50. And that difference, that compounds over time.
Yeah, it may not seem like much in the beginning, but over 10, 20, 30 years, those savings really add up.
Exactly.
Wow, okay. I never thought of it that way.
Yeah.
Even a small difference in fees can make a big impact long term.
Sure.
I guess it really pays to do your research. Compare those expense ratios.
It really does.
All right, now that we've got the risks out of the way, let's move on to the exciting part, actually getting started.
Let's do it. We'll dive into that in part 2.
All right, so let's say someone's listening and thinking, mutual funds. This sounds interesting. I want to try this out.
Yeah.
What are the first steps? Where do they begin?
Well, first things first, you got to set up an account. You'll need either a DMAT account, specifically for investing in securities, or a mutual fund account. And most financial institutions, online platforms, they offer these.
Okay, so that's the first step. What about opening an account? Is that a complicated process?
Not really. It's pretty straightforward. You'll have to go through a KYC process, which is Know Your Customer.
Right.
Pretty standard for any financial transaction nowadays. You'll need your ID, proof of address, and they might ask you a few questions about your investment goals and risk tolerance.
Okay, pretty standard. So getting started isn't as scary as I thought. Now, you mentioned online platforms earlier. Are those good for investing in mutual funds? Because I like to keep things simple.
Oh, absolutely. Online platforms have made investing so easy. They give you tons of funds to choose from. The interfaces are super user-friendly, and you get tools to track your investments.
Right.
A lot of them even have educational resources to help you learn more.
Uh-huh.
about different funds and strategies and all that.
So it's kind of like online banking, but for investments.
Exactly. You can research, compare, and even set up those SIPs we talked about,
Right.
all from your computer.
Wow, so it's really convenient. It makes investing accessible to pretty much anyone, no matter how tech savvy they are. So, okay, you've got your account, picked your platform, what's next? How do you choose the right mutual funds for you?
That's where it gets interesting. And it all begins with figuring out your investment goals. Why are you doing this? What are you hoping to achieve? Saving for retirement, a house, your kids' education, maybe a dream vacation.
Right, I bet your investment strategy changes depending on if it's a short-term goal or a long-term goal.
Exactly.
Yeah.
Your goals play a huge role in determining which funds are right for you. Let's say you're saving for retirement, which is a long-term goal.
Right.
You might be more okay with equity funds that have higher growth potential over time, even if they're a little riskier.
Mm-hmm.
But if it's a short-term goal and you'll need that money soon,
Right.
then a debt fund, with lower risk and stable returns might be a better fit.
That makes sense. It's all about matching the investment to the timeline, right?
Exactly. And another thing to consider is your risk tolerance. How comfortable are you with the idea of your investments going up and down in value? Some people are fine with a bit of a roller coaster, while others want a smoother ride.
Yeah, I guess knowing your risk tolerance is key to picking investments that you're actually going to feel good about.
Absolutely.
Are there any, resources or tools that can help people figure out their risk tolerance?
Oh, for sure. Plenty of online platforms have questionnaires or risk assessment tools that can give you an idea of your comfort level.
Okay.
And of course, there's always the option of talking to a financial advisor for more personalized guidance.
Right, especially if you're new to all this. It sounds like finding the right mutual funds is like a puzzle.
Mhm.
You've got to think about your goals, your risk tolerance, all the different types of funds, maybe get some advice along the way.
Exactly. It's not one size fits all.
Right.
The great thing about mutual funds is that there's so much variety. You can definitely find something that matches your needs.
And don't forget about disciplined investing, those SIPs. They can make a big difference over time. Right?
Oh, absolutely. Regular, consistent investing, even with small amounts, can really help you build wealth in the long run. It's like that saying, the best time to plant a tree was 20 years ago. The second best time is today.
Ooh, I like that. It really makes you realize that it's never too late to start, and consistency is key.
Yeah.
So we've talked about a lot today. What are your key takeaways for our listeners?
Well, I think the biggest takeaway is that mutual funds can be an amazing tool for reaching your financial goals, no matter if you're a seasoned investor or just starting out.
Yeah.
They offer a convenient and accessible way to diversify your investments, benefit from professional management, and potentially see great growth over time.
But as with any investment, do your homework, understand the risks, and choose those funds that match your goals and risk tolerance.
Exactly.
Don't be shy, ask questions, talk to a financial advisor if you need to, and most importantly, start investing.
Yes, take that first step. And keep in mind, investing is constantly evolving. So be curious, stay informed, and enjoy the journey.
Great advice. Now, before we wrap up, here's a final thought. We've covered how mutual funds work and how to pick them. But have you ever thought about using the past to help you make investment decisions?
That's an interesting way to look at it. What do you mean by using the past?
Well, we know that past performance doesn't guarantee future results.
Right.
But what if we could learn from how different types of mutual funds did during past market cycles, like recessions, booms, inflation? Wouldn't they give us some insights into how resilient and how they might grow?
That's a fascinating idea. I see where you're going with this. By looking at how different mutual funds performed in different economic climates, we could get a better understanding of how they might handle future challenges.
Exactly. It's like getting a glimpse into the future. Of course, we can't forget that the past isn't a perfect predictor of the future,
Sure.
but it can help us see how different types of funds react to market conditions and use that to inform our choices.
It's all about knowledge and understanding the bigger picture. The more you know about how investments have done in different situations, the better decisions you can make.
And you never know. That deeper look into the past might give you some aha moments,
Yeah.
that could really change your strategy and help you build a stronger portfolio. So as you explore mutual funds, remember to dig into that historical data. See what patterns and insights you can find. It's like having a financial time machine, right?
Yeah, exactly. And speaking of time machines, that's all the time we have for our deep dive into mutual funds.
But don't worry, this isn't the end of our financial adventures.
Oh, no, not at all.
We'll be back with more deep dives into all sorts of interesting money topics.
We've got so much more to explore together, like deciphering market trends, demystifying all those complicated financial concepts. We'll be your guides on this journey.
And remember, we're always here to answer your questions, anything finance related. We love hearing from you, so don't hesitate to reach out.
Absolutely. We love your questions and insights. They really help shape the show, so keep them coming.
Now, before we say goodbye, one last thought for you to consider as you learn more about mutual funds and investing in general. We talked a lot about diversification. But have you ever thought about how it applies not just to your investments, but to your whole financial approach?
Oh, that's a great point. Yeah.
We usually think about spreading our investments across different things. But it's also really important to diversify our income, our skills, even our experiences.
It's like building a strong base for your finances,
Yeah.
one that can withstand any challenges. Just like a diversified portfolio can help you ride out market ups and downs, a diversified approach to your finances can help you through life's unexpected events.
Exactly. So as you go on your financial journey, think about the different ways you can diversify your income, skills, experiences. Maybe explore a side hustle, take on a new project at work, learn something new. Those little steps can really add up to more financial security and freedom later on.
And who knows? Maybe on that journey of diversification, you discover hidden talents or new opportunities. You might create a more fulfilling life, both financially and personally.
So go explore, experiment, and really embrace that power of diversification in every way you can.
Yes, absolutely.
We'll be here rooting for you. Until next time, keep learning, keep investing, and keep diving deep.